Hey guys, welcome back to the second video of Small Business Finance 101. I'm Mani Karthik, and in the first video, we talked about income statements. If you missed that video, please go check it out using the link in the description below. Today, we'll be talking about balance sheets. As explained in the previous video, balance sheets are one of the three main financial statements of any company. In this video, you will learn what a balance sheet is, how it looks, what it holds, and why we use it. So let's go. So a balance sheet is basically a financial statement that outlines a company's capital structure at a point in time. In simpler terms, it tells where the wealth of a company lies as well as where and what obligations it owes. It looks something like this, but we'll come to that later. First things first, a balance sheet deals with two main things, which are assets and liabilities. And as you very well know, the underlying formula for balance sheets is this: assets equal to liabilities plus equity. Simply put, assets are what a company owns and liabilities are what it owes. Assets need to be equal to liabilities plus equity at any point of time. Why is that, you ask? Well, that is because whatever a company owns, called assets, it has either been borrowed, called liabilities, or someone has invested in it, called equity. Now, you must be wondering what equities are, right? Let me explain. Everyone who has watched Shark Tank knows that investors take up a part of your business's shares in return for investing money or capital in it, right? That's what is called shareholders' equity. These jargons might sound like a little fancy for now, but for a small business, everything gets simpler. As simple as giving this equity in return for the capital you borrowed from friends and family while starting up. Now that we know what the main components of a balance sheet are, let's have a look at where they go in the statement. Remember our favorite store, Mano Supermarket? We've taken their balance sheet to make it easier for you to understand. So on the left side are assets. They consist of current and non-current assets. Current assets are Mano Supermarket's possessions with quick liquidity and a turnover of a year. Non-current assets are those assets that span over more than a year. Now, their current assets are mainly cash, inventory, and accounts receivable. Accounts receivable is the money that they're owed by other people, namely customers, which they'll get back within a year, while inventory is the stock of products they currently own and plan to sell within the year. Now comes the non-current assets. They are things like equipment, land, office space, etc. They are fixed assets that will keep yielding profits for years to come. You need to deduct depreciation from these assets though. Depreciation is the reduction of the value of your assets due to aging, wear, and tear. For example, your machinery goes through depreciation every year, much like your office building, and so on. Adding current and non-current assets gives us Mano Supermarket's total assets. Now let's come to the other side. Here we have liabilities. Similar to assets, liabilities are also divided into current and non-current. Current liabilities consist of things like short-term debts, accounts payable, wages and employee bonuses, etc. Accounts payable and short-term debt is the money you owe to others, which you have to repay within a year. Accounts payable are for the sellers from whom you bought the products, while short-term debt is usually associated with banks and money lenders. Non-current liabilities generally include long-term debt only. Now we move on to equity. For small businesses, this generally consists of the owner's capital only, that is money invested from your pocket to start the business. If by chance you have investors, their investment would go here. Retained earnings are simply profits that you would reinvest in your business. These are the total liabilities of Mano Supermarket. They should be equal to their assets. This is all about the components of a balance sheet. But why do you need it? Well, the answer is simple. Much like any other financial statement, the balance sheet also shows where your business stands financially at a certain point in time. You can see where exactly your assets and liabilities lie, how much cash you have, and can also figure out how much you can expand your business. I'll explain how. Suppose Mano Supermarket's assets are majorly composed of land, office equipment, etc. It means that they can't expand or invest much even after having ample total assets, as all their assets are pretty much tied up. Whereas if they have liquid assets like cash or inventory, that means they have potential to expand their business easily. Similarly, more debt shows more liabilities for the company, while more equity implies more trust from investors. Now keep in mind that the balance sheet only shows the business's financials numbers at one particular time, not over a period of time as an income statement does. You need all three statements to get a comprehensive, complete view of your business's financials. Now that we have already covered the income statement and the balance sheet, in our next video, we'll have a look at the cash flow statement. Subscribe to our channel to not miss out on our next videos, and give us a thumbs up if you like this video. Do comment your feedback and also topics that you would want to know more about. Until next time.